All right. Hi, folks. Welcome. I'm Dan Passarelli, and glad to be here and glad to provide a little commentary on markets and such. Maybe find some trades together and answer any questions of yours that I can. Real quick, my background, several years ago, 1993, oh my goodness. I graduated college, went and knocked on every door of the Chicago Board of Trade building, got myself a job as a runner, and worked my way up to becoming one of the biggest traders in my pit. And then in 2008, I started Market Taker Mentoring, which is the global leader in option trader education, and wrote a couple books along the way. And that's who I am. Now I look forward to getting to know you more. So I didn't get to catch all of the everything presented before me, but I imagine somebody at some point went over some of the broad market stuff. You are seeing my screen here. So the S&P 500, excuse me, if we go to the year chart, if we go to the 3-year chart, you know, we almost made some new highs. Obviously, this was driven by the expectation for the Fed to come out and say that they were going to start cutting rates sooner rather than later, for whatever that means. And that is indeed what happened. Almost kissed a new high here. There is some chatter that the market is perhaps overbought. But you know what? The reality of it is, it's more how the market reacts to things than whether numerically it actually is overbought. And Ekeen, I think you probably have to move the camera of me, I think. All right. So that being said, one of the things that has come into working again pretty darn well are credit spreads. And you know, credit spreads are a pretty versatile strategy that can work in a lot of different markets, not all markets, but a lot of different markets, especially a market where there are a couple of things present. So if you're taking notes, you're going to want to write this down. And actually, before I do that, I want to take a little bit of a poll here. So if you wouldn't mind, please go to the chat box here on what is this? Zoom. Yes. I'll use GoToWebinar sometimes. I had a little senior moment there. Please go to the chat box on Zoom and tell me if you trade credit spreads or have traded credit spreads. Just give me a yes or a no, a Y or an N. Okay. And it's important for you to answer this, because I want to get a good gauge here of who we have here in the audience. So far, it looks like the no's are in the lead here. Just eyeballing it, I'm thinking maybe it's about 25% do or have traded credit spreads, which is perfect. Okay, that's great. Thank you for your participation. I do appreciate that. All right. So credit spreads, you know what? In fact, I'll tell you what, as long as we're talking about this, would you like me to give you a complimentary ebook on credit spreads? Give me a yes if you would like me to give you a complimentary ebook on credit spreads. Just make sure I have the right link here. Yes, yes. Oh, okay, okay. Good. It is a trade that you should be interested in. Slash AYT, I think should be it. Oh, no. Earnings announcements. Yes. Earnings announcements. Oh, we didn't even talk about earnings announcements yet. I'm going to share that link later. So let's talk a little bit about credit spreads, and then we're going to talk about earnings announcements. So credit spreads tend to work when the market is in a range, and preferably a wide range, okay? And when implied volatility is elevated. So we do have a bit of a range here. Like, you wouldn't expect it, because the narrative that we've been talking about was a big run up in the S&P 500 over 2 months, and then a bit of a pullback. But if you look at the chart, we have established a little bit of a range from about 466 to about 477, $12 range, which is about 10%. Yeah, which is about a little over 10%, almost 15%. So and then the way we measure implied volatility is, you see this red line on my volatility chart here. That is the implied volatility. The blue line is historical volatility. And what that does is, this tells us that implied volatility is slightly overpriced, which means that options are slightly overpriced. So that can make a lot of sense for credit spreads. Now, we could construct credit spread here in the S&P 500, spiders specifically, but we're going to have to be very conscious about how we manage it. Because while we have been in a range for, what is this, about 3 weeks, almost a month. Well, we have been in a range for almost a month. There is the chance of breaking out. And when that happens, we have to cut our losses quickly before they become bigger losses. So we could conceivably sell the upside, selling the 477 calls and buying a higher strike. We like to keep those strikes close. Let's take a look here. If we go out to the 7-day, we could sell the 477 calls at 112 and buy the 478 calls at 88 cents or so. We can model that to be mid-market. That's collecting 27 cents on a $1 wide spread. So we're basically risking 3 to make 1. And as long as the market doesn't make basically new highs in the next 7 days, we're sitting pretty. Okay, now this is why I wanted to get into earnings. So earnings season is upon us. We've got some of the banks and other financial companies set to announce within the next week. About 70% of the earnings announcements that come out in basically what I would call pre-earnings season, that first week or two of earnings season is sort of the cusp where there's not a massive amount of earnings trading opportunities, but there are some. So in my analysis of financial companies and what to expect, we expect to see a decline in earnings for financial companies. Now, it's kind of a little known fact. I mean, for people who trade earnings, I guess it's not a little known fact. But some of you may be surprised here that when it comes to earnings trading, most companies outperform what analysts give guidance. The analyst expectations, most companies outperform those on a regular basis. It's something like 70-some% of companies outperform. Now, you would think that analysts would just get better and more accurate, but I think it might be this sort of little game where the analyst slightly underestimates that they outperform, but that's just me. So that being said, we're expecting a decline in financial companies, not necessarily insurance companies, but the other financial companies, the banks, the trading firms. We're expecting a decline in earnings. Now, if we see that, and if they don't outperform like basically they're expected to do, that's going to weigh on the market. All right. We're in this sort of gray area right now where sometimes good news is good news, and bad news is bad news, and sometimes the opposite. Sometimes good news is bad news and bad news is good news, because the market likes to get ahead of the game and If we get bad news, that could mean that the Fed is likely to start cutting interest rates early, but we're in sort of a gray area. We're in the good news is bad news phase for a while, and now we're kind of like going back and forth. Sometimes it is, sometimes it isn't. That being said, we want to take a look, and let me just take a look and verify when some of these bank earnings are. And any questions that you have too, by the way. Okay, Keen. Any questions that you have along the way, I'll be happy to answer in just a minute here. We are in this week. Let's see, Wednesday. We've got well, actually here, I'm going to show you another little trick here. Earnings trading is one of the specialties that we focus on. So I'm going to show you. In fact, let me take another poll. Give me a yes if you've traded earnings before. Give me a no if you have not traded earnings before. Yes, no, yes, no, yes, no. Boy, this one looks a little bit split, almost 50-50 here. Yeah, this one looks about split almost 50-50 here. That's interesting. So here's one. If you Google stock symbol space investor relations, this is the most accurate way to get the earnings announcement state. Sometimes, I mean, you could get them through brokerage firms. You can get them through, Yahoo Finance. You can get them through a lot of sources, but sometimes they're wrong. So I just Googled GS space investor space relations, and I pulled it up, and we see that January 16th is their conference call, which is actually more important to the stock price direction than the actual earnings number that gets released, which is another thing that I think a lot of people might sound surprising to them. And here, let's look at another example. BAC, Investor Relations. It's Bank of America, Investor Relations. I always go to events and presentations. And January 12th, which is, oh my goodness, January 12th, that's Friday. Holy moly. And that's 11 a.m. Eastern time. So that's about a half hour after, hour and a half after the market opens. Yeah, hour and a half after the market opens. So we're going to start looking at Bank of America here. BAC. And do you want me to share with you my strategy for trading earnings? Give me a yes if you want me to share my strategy for trading earnings. Yes, says Julia. Yes, says Zach. Tom. Anyone else? A couple more people and I'll share it with you. There we go. All right, that's what I'm talking about. Okay. I just like to know that you're interested in what I'm talking about. Otherwise, I'll talk about something else. So let me give you a background here. So when I was down on the trading floor, trading in the pits as a market maker, at one point, I was one of the biggest traders at my trading firm, one of the most successful traders at my trading firm, and my risk manager would kind of let me trade anything I wanted, except earnings. I was never allowed to have a position going into earnings. Isn't that crazy? And now I'm like, that's one of the things that I'm an expert on is trading earnings. So why was I not allowed to trade earnings? Because it's the most unpredictable directional day of the quarter. Like I said before, stocks tend to outperform analysts' expectations. And if they don't outperform, sometimes they can go down. And like, it's just, and the conference call, what they say about the future is really the most important thing. So directionally, anything can happen on earnings days. So long story short, well, long story medium. One day I found myself on the telephone with a producer from Bloomberg Television. This is about maybe 7 years ago. And long story short, he wanted to interview me down on the trading floor. And I said, okay, what do you want to talk about? He said, well, Apple has earnings coming out. We'd like you to share a strategy to trade Apple going into earnings. And I was like, oh man, I've never done that before. And you know, like I always put my money where my mouth is. Those of you who are familiar with me know that. And so if I'm going to talk about a trade going into earnings, it's going to be a trade I have on. So I went and I studied Apple, and I was like, well, we can't do credit spreads there. Credit spreads would be terrible going into earnings. Can't do, because anything can happen directionally. Same with iron condor, same with covered calls, cash secured puts. I'm like, what can I do? And I looked at a time spread, and time spreads can potentially be very good going into earnings. In fact, I want you to write that down as well. Time spreads, write this down. Time spreads for earnings when criteria is met. And this is the ebook that I wanted to share with you. Earnings time spreads are very, very powerful trades when you do them right. So I want to introduce that to you in an ebook. And David was kind enough to post the link in there earlier, but it's just markettaker.com/AYT, markettaker.com/AYT. And there it is again. Thanks, David. That is my ebook on how to profit from earnings announcements using options. So now I want to give you a little bit of just basically of a live demonstration. So what's the first thing we look at when we're analyzing a stock? Well, typically it'd be the chart, but in this case, not so much. We need to find a way to make these trades going into earnings in such a way that direction doesn't matter. Now that seems pretty crazy, right? How do you make a trade, a big trade, on a day when the underlying stock is probably going to move a lot going into earnings? How do you do it? Well, an at-the-money time spread can be one of those ways. There are several factors that go in to trading earnings. One is we need tight liquid markets, which of course we have with BAC, right? Bank of America. 67 bid at 69 cents, 44 cents bid at 46 cents, 93-cent bid at 94. The reason is because whenever we trade spreads, well, whenever we trade anything, we're always giving up a little bit of what we call market maker edge. Market makers value, like if you can see on my screen here, these January 19, 33.5 calls, market makers value these at 81 cents. But if they buy below 81 cents, they look at it as, hey, I made a theoretical penny. If I sell above 81 cents by 1 cent, they look at it as, hey, I locked in a theoretical penny. And they just lock in these theoretical pennies all the time, over and over and over again. And it adds up to a lot of money. Which is probably another thing that I think a lot of people would find surprising, that market makers aren't swinging for the fences, you know, like we are. They're just collecting pennies over and over and over and over and over again. That's one criteria. We also want to see, and there's lots of volatility, and some of that I cover in the ebook. And if you get the ebook, I'm actually going to do you one better. I'm going to send you an invitation to an online training that I'm holding where I go deeper into this and really give a good explanation. Okay, so one of the things we need to look at is volatility. And we basically what we're trying to do is make money on options that end up becoming overpriced by trading them in such a way that when they become fairly priced, when that sort of inflation factor, which we call high implied volatility, comes out of them, we make money on that trade. As long as the underlying stock doesn't move too much. And so here, I'll just show you a quick graph of what this might look like. Now, again, there's a lot of criteria. The one takeaway I don't want you to walk away from this with is, hey, Dan said just go trade a time spread on everything that has earnings coming out. That's not going to work. It's got to meet certain criteria. But I want to show you what a time spread looks like and give you an idea how that works. So here I could sell. Oh, wait a minute. That's two different strikes. Hold on a second here. So here I could sell these 33 and a half calls. I actually would choose a different one, but a different strike, but I just want to do this as an example. Sell the 3-day 33 and a half calls, buy the 17-day 33 and a half calls. Now, another one of the keys is we always do this the day before earnings. So I'm definitely not going to make this trade now. I'm just giving you a rough idea how this works. When you read the ebook, when you attend my webinar where I have more time to break it down and go into things, it'll be more elaborate. But basically, this is what we end up with. So as long as on earnings, the stock doesn't move, doesn't fall below 32.24 or rise above 34.93, 93, the trade will make money. Now, that being said, that's right now, that's too tight of a range. This stock can definitely move that much on an earnings day. And, we can confirm that by going back and looking at the history of it, which is very, very simple to do. But as time goes on, the options are going to get more, some of these options are going to get more expensive, which is going to cause these bid-ask spreads to further widen. And once they get to a point that is wide enough that meets that criteria, that's when it's okay for us to go in, not just okay, but it's statistically in our favor to go in and buy time spreads going into earnings. Okay. Wow, that was quite a brain dump there, wasn't it? A lot of information there, wasn't it? I am going to I'm going to invite you to send in some questions that you might have about the market in general, about other things that I might expect from this earnings season. And while you're doing that, I also want to, let's see here. This is another thing that I'll do is I'll go like, well, actually, no, let's look at tomorrow. Tomorrow morning, and this is just Yahoo Finance, and they're not always accurate. So I always start there, and then I go and, oh, no, that's it, huh? And then I go to their investor relation page. Let's see, what do we got coming out after the close today, maybe, huh? Tilray, I don't think that We also only want to trade earnings on stocks that are above $25 a share. Write that down. That'll also be in the online training that you'll attend. Let's see here. Yummies. And what I do is I just sort of eyeball it and I look for like the brand name companies, just companies that you're familiar with, you hear talked about. Those are the ones that are more likely to have tight liquid markets. Yeah, so Friday is really the best that we got. So we're going to be preparing for Friday's earnings trading. Next week is going to be, it's going to ramp up a little bit. That's when we get a lot of the other financial companies announcing earnings. And then the week after that is when we really start getting into it. In fact, the week starting January 29th, that is when we're going to see just a massive amount of earnings trades. In fact, here, let me show you this. Yahoo. Bring this back up here. So this is this week, right? We've got 37 earnings, 134, 37, 35. Okay. Next week, still pre-earnings season. We have a few more, about the same, really. The week after that, now we're starting to get into there, but when we get to that week that starts January 29th, we've got a couple hundred here, a couple hundred here, a couple hundred here, 100 here. Friday ends up being slower, which is great. And we have to, one of the things about trading earnings is we have to crank through a bunch of them. For those of you who have traded any style of trading for a long time, the one thing that by now is that what we're not trying to accomplish is we're not trying to have that one trade where, it makes our career, I mean, it would be great if we have that, but that ends up being a little bit serendipitous. What we really want to do as a trader is we want to get a lot of singles and a lot of doubles over and over again and crank out money because we're trading with edge. We're trading with a statistically sound system where the odds are in our favor. The odds are in our favor of winning, and the risk to reward ratio is also in our favor. We're risking less than we otherwise would with a similar strategy because of volatility and some other factors. So that's why it's really important to have the system down pretty well by the time we get into this week, the week of January 29th. Again, this week, there's like Bank of America might be the only thing that I trade this week. Next week, probably make a couple of trades. But this week, of the 181 earnings, 178 earnings, 202 earnings, a lot of them are still small companies. I'm going to look to be trading probably between 4 and 7 earnings trades a day. Now, these earnings trades, when done properly, they're very short term in duration. We put them on the day before earnings is announced. In fact, in the last hour of the day, and we take them off the next day. These are less than 24-hour trades. Now, there's a massive advantage to that if you think about it. One is, this market it's gotten to be pretty unpredictable. For a while there, we just climbed for 2 months. That was getting to the point of being fairly predictable. Now, we've got a lot of differing opinions. I was just reading something in Bloomberg this morning where there are some trading firms that are saying they expect the first rate cuts in April. And then there are some other ones like Goldman that says it'll probably be more like July. And then Morgan Stanley says, no, it'll probably be like September. We're getting a lot of differing opinions right now. And when we have a lot of differing opinions, the market itself can be a lot more unpredictable. And sometimes it feels like it doesn't make sense. It does, but usually we kind of have to wait until after the fact to backtrack what the psychology was on what somebody was thinking. So moral to that story is when we're putting on trades that have like even a week to duration, it can be a little bit tricky when the market, has like a day like yesterday where it was up 1.5%, and then the next day it's down, and the day before that it was down. So being able to keep these trades held only overnight, which is also beneficial because sometimes you think about short-term trading, you think of day trading. If you don't have $25,000 in your account, you can't day trade. These we're holding overnight because we want to hold it just through the earnings announcement. And so you don't even need $25,000 in your account. I've had people start trading this with $5,000 accounts. This is the best, the most effective trading system that we teach. It is our most popular trading system. And we've got lively chatter in our chat room with people sharing, helping each other with these every day. And man, it works really, really great. So moral to the story is we're going to screen through a lot of these. If there's 200 earnings trades in a day, I might make 5 because I only want to take the best of the best of the best. The ones that have the tight markets, the ones that have edge, the ones that have all these great things going for it. Whew. All right. That was a lot too, wasn't it? Oh, and by the way, so yeah, this is really the week that we want to be prepared for. And good news, when you go through the ebook, again, markettaker.com/AYT, when you go through the ebook and you attend the bonus live online training, and then you follow through, you'll have plenty of time to get boned up on this by January 29th. That's a real key date because then like the week after that, we got 250, 234, 235, 100. Week after that, we're in the 200s again. The week after that, in the 200s, we got 348 this day. Still, we got almost 500 this day. I mean, we might be making 10 trades, this day, right? So really, really important to get into the training now. Well, when I say get into the training, we're going to do it in baby steps, right? Read the ebook, attend the online training, and follow through, and you're going to get it. Okay. Can I answer any questions for you on what I expect this earnings season? Other trades that I'm looking at, what to expect from this earnings season as far as its result on the market overall, and anything else. While you're thinking about that, and put it in the chat box. I don't know if there's a questions box too, but put it in chat if you will. All right. So in the meantime, another thing that I want to look, should I go there? No, I'll skip that part. Another thing that I want to look at is yeah. Oh, you know what I wanted to look at? I want to go back here. Oopsies. Come on. Man, I think there's more potential this earnings trading season than any earnings season that I can remember. We've actually got a number of earnings coming out Friday morning. BlackRock, Delta Airlines, Wells Fargo, JP Morgan, Citigroup, United Healthcare. All these are going to be very, very good candidates for trading earnings. So that is really going to be the first day this quarter where I'm jumping in there. The question was, do you have a trade for BAC? So I do. Okay, so BAC, as you can see, Bank of America Corp has earnings on Friday before the market opens. So let's see if you caught this. When would I put that trade on if it meets the criteria and if I make the trade? And if I do, it's going to be either a time spread or a straddle, probably a time spread. When do I put that trade on? If earnings come out Friday morning before the open. No takers? Come on, I told you this already. You got to take good notes. When you're presented with a trading system like this, there you go. Hillbilly Jim, I like it. Thursday, that's right. Thursday at the end of the day. We always put it on the session immediately before earnings. So if it comes out before the open, on Friday, we're going to put it on Thursday afternoon. If it comes out Thursday after the close, we're going to put it on Thursday afternoon. So I basically just did like a pre-analysis of BAC to give you an idea of what to look for. But, again, that's why I want to shower you with a whole bunch of information before Friday, before next week, especially before the week starting January 29th. I'm going to shower you with a ton of information so that you are prepared to go in and trade earnings. So yeah, no, I don't have a trade yet for BAC, but Thursday afternoon I may. Okay, so Moisey, did I say that right? Can you explain implied volatility? Yeah. Really great question. Implied volatility is one of the most underrated things to look at as an option trader. It is essential to analyze implied volatility on every single trade, not just earnings trades, but all trades. Because whenever you make an option trade, you make or lose money based on really three major things. There's a couple others, but three major things. One, the stock going up or down direction. Two, what's the second thing? Who can tell me? What is the second thing you make or lose money on when trading options? You can tell me the second and third things because there's not necessarily an order here. Who's going to say it first? Got some experienced option traders in here? Some of you who trade credit spreads know where I'm going with this. There we go. Thanks, Bond. Time. Now, I'll get to that one in a second, Moisey. Time, right? When time passes, options lose their value, and that's measured by theta. You always make or lose money on direction and time. And the third thing is volatility. Okay. Now, Moisey said volume, and that's a fair answer. That's more of an ancillary effect, I would say. When there's more volume, like here, as you can see in BAC, there's thousands that trade, just today so far, right? That tends to make the bid-ask spreads very, very tight. if we look at a stock like ALB here, that's not totally illiquid, but it's less liquid. You know, there's less volume trading, a lot less. And so therefore the markets are wider. And so it's really the effects of the markets being wider, which is the best measure for liquidity. You know, you combine that with volume and open interest for sure. But when the markets are really wide, it just gets harder to make money. So yeah, that's a good insight there, Moisey. But the keys are direction, time, and volatility measured by delta, theta, and vega. Okay, so because we know that direction, time, and volatility are the three major things that we're going to make or lose money on, we've got to take into account in our forecast all three of those things. What direction do we think the stock's going to go? And when it comes to earnings time spreads, we just get rid of that factor. We make it what's called delta neutral, direction indifferent. The delta is close to zero, which means there's not much directional risk. We have volatility risk then that comes in the form of gamma, which is, I want to keep the conversation pretty basic here, but basically all that negative gamma says that if there's too big of a move in either direction, you lose on that. Time decay, it's only a 2-day trade, or no, it's only a 1-day trade. We just keep it overnight. So we're really isolating our profits into implied volatility when it comes to earnings trading. So implied volatility is this. This is a volatility chart. The blue line is historical volatility, which is just the annualized standard deviation of the closing prices. Now, if you're not like all into math and stuff, and if you're not, that's okay. You know, you don't have to be a mathematician to be an option trader. All that means is the bigger this number, the more the stock has moved around lately. Okay, that's the blue line. Now, the red line is implied volatility. The best way to understand this is think about why options even exist. What is the fundamental economic purpose for options even being legal to trade, allowed to trade, right? It's expectations and fears of future volatility. If the market is going crazy, whipping around, there's a lot of fear that there could be a major sell-off. That's when investors are more likely to buy puts, right? When the market's boring, like this time period here, when the market was just climbing straight up for 2 months, nobody was buying puts, nobody. When the market pulls back and there's fear that there's volatility, could be some downside risk, people are more likely to buy puts. When the market's really boring, people do things like sell cash secured puts, sell covered calls. That makes option prices lower. When they're buying puts, that makes option prices higher. This is just, you remember supply and demand? If you ever had to take an economics class, they don't teach economics in school anymore, or history, or, you know, there's a lot of things that I think they ought to be teaching in school that don't. But for those of you who are maybe a little older, you had to take an economics class, which probably made you a lot smarter in life. You learned about supply and demand. When people want more of something, there's more demand. It drives the price higher because there's only so much supply. When people aren't buying something and there's a lot of supply, the people supplying the good or service have to make the prices cheaper if they want to sell them because there's not as much demand to meet that supply. It works the same with options, but volatility is a big part of that. When we expect future volatility, we're just more likely to execute option buying strategies, which creates demand, drives the price of options higher. When the market is more complacent, we're much more likely to sell options, and that pushes the price down. So that is what this red line measures, okay? And as you can see, the red line, today's red line is above today's blue line. That is one indication that implied volatility is high and that options at this moment in time are overpriced. If we look at another chart, here, XPO, same thing, although I think they have earnings coming out sooner. What was that one I was looking at? ALB. This one, there was a point just about 4 days ago where options were actually underpriced in ALB. And that would have been a strategy that we would want to maybe consider buying options. Now, these volatility charts are just a starting, okay? We definitely need to dig a little deeper and do some term structure analysis. Hey, Vaughn, yes, as a matter of fact, it is. I have the Mesa race up here. Yeah, that is a proprietary one that I created. Yes, that's correct, sir. Or ma'am. I have created a number of, sir, okay, excellent. I've created a number of proprietary indicators and scans and spreadsheets that help simplify my trading because, you know, to be successful with trading, you need a couple of things. One is you need a consistent plan. You can't be like, oh, I'm in a good mood today, so I'm going to make this kind of trade. The next day, oh, I'm in a bad mood today, so I'm going to make this kind of trade. So we need to do it based on logic and do the same thing every time we make a trade. And that can still be very, very time consuming to find these trades. So we need to have a number of shortcuts that make it very easy to find them and easy to analyze them. So yeah, accurate vol Mesa races is my own indicator. Yeah. You guys are asking great questions and you guys are giving good answers here too. I love this. So BlackRock, somebody wanted me to look at BlackRock. Symbol is BLK. So again, we don't care much about the chart. In fact, we don't care at all about the chart because we're going to try and not care about direction. And yeah, Pawn, I do share, there are a number of things that I share complimentary to members of any of my stuff. In fact, if you download, if you grab that ebook, markettaker.com/AYT, read up on earnings, attend my live training, which I think is next week, if I'm not mistaken, and follow through. Yeah, there's a whole bunch of stuff I share with you. Sure, of course. So we're gonna trade this what we call delta neutral. We're gonna get rid of the directional risk. We're only gonna have the volatility. It's interesting here that the implied volatility is actually slightly below the historical volatility. So today, I'm not going to make any trades in any earnings thing because we don't have any coming out until Friday morning. So again, when am I going to do the final analysis? Thursday afternoon, and I'm going to take it off Friday during the day, ideally be out before lunch, less than 24 hours. What I'll likely be looking at is a time spread. And with the time spread, we're always selling what we call the front expiration, which is the one that expires immediately, the fewest days after earnings. So basically, we're going to be on this Thursday afternoon, if we make the time spread trade in BlackRock, we're going to sell the options that expire that Friday, the very next day. And then we're going to buy a further out option. And I'm not going to know which option to buy until Thursday afternoon, just based on a volatility analysis. But that is what we're going to be looking for on Thursday. is a time spread and see if it sets up and matches the criteria. Now, what is this? BJ Barner wants to know about Upstart. And I don't know if are you talking about for earnings or just general thoughts on it? Earnings, we can always, we just eyeball and say, well, the last earnings was on 11/7, so the next one's probably going to be around February 7th. Oh, just in general? Okay. Yeah, because they're not going to have earnings for a couple of weeks. So we could easily go here, oops, and go, we do still need to know when their earnings are, because there are certain trades that we don't want to carry going through earnings. Oops, silly. UPST Investor Relations, Events and Presentations. November 7th. They may not have even, I don't think they even announced it yet. Yeah, they didn't even announce it yet. So it's probably February 7th or after. So the reason why we need to know that is we need to trade something probably that expires before February 7th. We don't want to carry a position going into earnings. And based on, So I look at this. I always like to pull up the news. And there hasn't been any news except a related article on the 3rd, which was 6 days ago. So no news. So in some ways that makes the job easier. We can look at it from more a pure technical standpoint. We've got the 50-day moving average here, which acts as support. The 200-day moving average here, which acts as support. There is more support here where we bottomed out 3 days ago at about 32.75, and then more support down here. We've got really, really strong support. One thing about Upstart is, let me just check something really quick here. One thing about Upstart is they have very, very high short interest, which means they are potentially a short squeeze candidate. And, we may have seen some of that here and maybe here a while back. So we want to be very, very careful selling credit spreads and things to the upside, because when we get these short squeezes, sometimes they can explode. Like, look at the range here, a low of 26.05, a high of 32.75. That's like $6.70 move when the stock was at 26. That's like 25% move, So we don't want to be doing a lot of call credit spreads, but put credit spreads on something like this, especially when the options are pretty overpriced, can be really, really powerful. So I'd be looking to sell as low a strike as I can. It would have to be below 32 because I want to sell below this 50-day moving average. If I can sell lower, that's better. What did I say, 32? And we're going to go a bit further out in time here. Wow. See, when the implied volatility is so high, we can actually go 10 days out. Man, we can actually go like to the 17-day out expiration and sell like what was the 50-day moving average here? The 50-day or the 200-day moving average is 30.85. So if I could sell like the 31 strike and buy the 30 strike puts, model that out. That's a pretty solid trade right there. Oops. Stretch it out a little bit. Oops, I stretched it out a little too much. No, that looks good. This is a pretty solid trade. As long as we don't fall below literally the exact 200-day moving average. And the 200-day moving average can act as support or resistance. Like, look, here it acted as support for like the entire month. And it can break through sometimes, but here it acted then as resistance for about 2-3 weeks. So this is definitely a support line. Actually, I'm kind of liking this trade. I don't like it. Basically, as long as the stock stays above, where's our break even? Right here, $30.74. As long as it stays above there, the trade's a winner. And it got massive support helping protect that trade. Okay, man, you guys are great. You guys are asking really great questions. Again, the most promising trade that you have over the next few weeks is getting into trading earnings. markettaker.com/AYT. Get that ebook. You'll get an email, register for the online training, and move forward after that. And you're going to be prepared. Thanks again, David. Now, I think I've got about 2 minutes and 10 seconds to maybe if there's a super quick question that's like borderline yes or no, I can answer it. If not, I'm going to pass the baton back over to David and team, the good folks at Timing Research. And yep, I guess we're good then. All right. Hey, thank you for spending your time with me. And